We are seeing the effects of shutting down the economy. It's sort of like you can't, turn an economy off and back on again. And so we're seeing the results of that. It is way worse. That's why we're seeing that. And what we can see here is back to this rate hike. This is the futures market, and we can see what the percentage of people are betting that the rates will be higher. And of course, about 50% of the market thinks that we are going to see greater than 75 basis points, or a 75 basis point hike. So if we've already seen one of the worst drawdowns in the NASDAQ that we've seen, except for the short little blip in March 2020. If you take that out of the equation from the Black Swan event, then we haven't seen this far of a crash since the great financial crash, the global financial crash. That's where we're at. So if we've already seen that from two small little 0.25, 0.5 hikes, what would 0.75, what would 100 points do to the market? Well, we can see that it's breaking a lot of things in the market. And that's the key. What is the point where the market breaks? So what we can see here, and this is interesting, this is the government bonds, the 10-year bond. And what we can see is they've been operating in this channel since the 80s. Remember, back to the 80s when we had the high inflation. And they've been operating this channel, but what we can see right here is that they've broken out. So this means that bonds are selling off. And this is a bad situation because if you have your money in a 401k or some sort of a pension, most likely your financial advisors put you into some 60-40 split. And what's happened since the 80s and even before that was that the last 100 years was that you would have a stock bond split, equities and bonds. And the reason why you do that is when equities sold off, you'd go to bonds. Bonds were the safe place to be. That was the income. And then you'd go back to equities. And so you'd have some sort of a blend there. But now they're selling off and they're no longer a safe haven. And so what we have here, we can see the S&P 500 down years. So the years when it crashed, going back to 1977, whenever the S&P 500 crashed, the bonds would do good. And we can see that. And so if you had a 60-40 bond portfolio, you held up pretty well. So in 77, you lost 7% in stocks, but you gained 3% in bonds. So you only had a net loss of 0.3. Most of these years, you had barely any loss at all. It held you pretty even. But we're in a different year. We're in a different era. And you can see 2022 at the bottom. The S&P 500 is down 17%. Of course, let's see, we're actually down 22%, so this chart's not totally up to date. So it's down even worse than it was before at the same time that the bond market is crashing. So the stocks and bonds are crashing, and so if you were doing some sort of a 60-40 bond split, you're just down. And so we're in an environment now where there's nowhere to run and there's nowhere to go but down. So when does the Fed pivot? Well, we don't know. Remember, we went back from being financial analysts to now political analysts, and we're trying to guess when they'll pivot. My guess is potentially at the end of the summer. Remember, going back to the article, we looked at President Biden's Democratic Party. All eyes are focused on this midterm election. They don't want to lose the control of the government, and a recession, a double-digit, the worst drop in the NASDAQ since we've seen since the great financial crash. That's not something they want. I'm guessing sometime by the end of the summer, they could pivot. But what do you think? I'd love to get your take because my crystal ball is kind of cloudy. What's yours saying? Leave me a comment and let me know what you think down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, give me a thumbs down. That's okay. But at least leave me a comment and let me know why. And don't go. Hit the subscribe button so you don't miss any more of these videos, all right? That's what I got for you today. To your success. I'm out.